Hello, I'm Thomas Taplin and welcome to the weekly wrap-up. Every Friday we look back at some of the week's top stories and events that shook the markets. Today I'm joined on the line by Todd Gordon, Chief Market Analyst of Aspen Trading Group. Todd, talk us through what's really stood out for you this week and why.
Sure. It started off this week kind of a continuation of what we've seen in September and October, which has been kind of a low volatility environment. A little bit frustrating for traders on the whole. We haven't seen ranges expand. We're not really gaining any traction one way or the other. And then it was kind of interesting. In the beginning of this week, we came out with some strong data. Australian CPI was hotter than expected. We had obviously some poor German and European data, but I think on the whole, the U.S. data was surprising to the upside. So we kind of had this push and pull dynamic in the beginning of the week. As we got later on and further progressed in the week, we started to see some poor data, specifically U.S. earnings, that kind of broke us free from this range that we've been caught in. And now, as we end the week, we're pushing the lower end of ranges. Vol is spiking, ranges are spiking. So it looks to be that the bearish side of the risk trade is starting to take hold, which is good news for traders of the FX market.
Now, we saw a surprisingly high figure of 1.4% for Australia's CPI data on Wednesday this week. Is this unpredictable sign of inflation in Australia something the markets will want to keep a close eye on in the near term?
Well, it is, and it was a little interesting because the RBA, the market had really considered the RBA as a shoe-in to cut rates, and then we come back on a 1.4% CPI. Expectations were for 0.9. So then it's very quick to say, RBA rate cut is off the table. But in this kind of market environment, commodities falling as precipitously as they are, stock index is falling. You can't discount a RBA rate hike or cut. Excuse me. I'm thinking ahead over to Canada. I mean, Canada came out with a rather bullish outlook on their economy, and they were rather hawkish in their rhetoric, talking up interest rates. But again, I mean, I just don't see relatively stronger economies like Australia and Canada able to hike rates with a market headed where it's headed right now. So I think those expectations are going to be pared back. The HSBC number is always, I think, one of the most important numbers. It was the flash manufacturing PMI, so it was the kind of lead into the manufacturing PMI. It came out at 49.1, still below the 50 expansionary level, but it's still better than what markets had thought. The prior was 47.9, and I'm seeing it was actually revised up at 10th. So China PMI was not as bad as everyone thought. And, of course, the threat of any kind of policy intervention by China is still very much on the table. So Australia's been trading well to the upside. I think, again, for your short-term traders, you don't want to fight the prevailing risk trend, which I think is lower in commodity stocks and foreign exchange. So I would think for the Australian dollar, you might want to pair that up against that Euro-Aussie. Euro-Aussie is the real mover in here. And I think if you want to express your long Aussie via these numbers, you do it against Euro.
Todd, moving over to Europe, what are your thoughts briefly on Germany? Because we've had some disappointing manufacturing data also on the same day as Australia's CPI data. If this gets worse, Germany could be looking at austerity measures, couldn't it? Yeah,
absolutely. And I mean, it's interesting is Germany's kind of teetering on recessionary boundaries here. We've got European sovereign bond yields kind of easing up, and specifically leading back to Spain. The impetus for Spain to request a bailout is coming back, even despite we have, as you said, some weaker German manufacturing data. So we need to really keep an eye on those Spanish bond yields ticking up, which again would put the impetus back on Spain to request a bailout from the ESM, EFSF. Ireland also is in the news as well. The IMF downgraded those guys. GDP forecast, I'm just looking at my notes, down 1.1% from 1.4%. So Ireland is back into the circle of fire, so to speak. So if we kind of get this continued earnings disappointment coupled with rising sovereign bond yields, and especially Germany kind of moving into a soft spot in the economy here, we could have kind of a triple threat here of risk aversion dollar buying.
Now, on Thursday, we saw UK GDP surprising on the upside by growing 1% quarter on quarter in Q3, having spent the last year flatlining. Now, factoring in the Olympics, we shouldn't get overly excited about this figure, though, should we?
Yeah, the Olympics, and it's funny. I actually did a bit on my CNBC show Money in Motion, and I actually did a study of the currencies of the currency of the economy that hosted the Olympics in the 6 months after. And I'd have to go back and look at my notes, but there's actually a pretty reliable gain in the currency in the 6 months following hosting of the Olympics. So it's something we're going to talk about on the show tonight, and it's actually playing out. So I think exactly, Thomas, to your point, it is a one-off. Again, you don't want to fight the prevailing risk trend in here, which I think is lower. Just like I talked about Euro-Aussie, a great downside trader, I think Euro-Sterling actually is a nice downside trader as well. It had an explosive downside week. So, to take advantage of some of these one-off strong data points with the UK as well as the Australian dollar, I don't think you want to do it against a short dollar position.
Okay, thanks for joining me, Todd, and running through some of the week's main events. If you're watching at home or at work, don't forget to check out Navjeet's broadcast on the week ahead today. But for now, I'll leave you with some of the best quotes we've heard this week from the professionals. Goodbye.